So here we go, guys. This is August 21st. So Matthew Tobin, Omar Khan, David Jarvis, and this is the fund update call. We're gonna take you through the slide deck, guys. Tell you what's going on in the fund. Talk a little bit about what's going on in the market, and we actually thank you for tuning in on a very sleepy month. This is the sleepiest month of the year in August. August is the sleepiest month of the year. So yeah, and of course, let's be on to YouTube, over the next day or so. So we're going to talk, as we said, about themes that are dominating the landscape. We talk a little bit about outstanding positions and what we're looking for into the next few weeks, and also like the next month or two, because sometimes I think of September and October. They almost seem like one 6 week period. And I know there's 8 weeks or what have you. I get that, but it seems like this one combined 6 week period of just uneasiness, for lack of a better term, but uneasiness. So what's been going on lately, right? So the Nasdaq did fall, it has since regained traction there, about 13%.
I want to say something here, Matthew. So we've been in a bull market for the entire year, okay? But what happened is every so often you get a pullback. The markets pull back and they do their thing. We had a really strong pullback in a very short period of time. But because of the macroeconomic, environment, as well as this being an election year, it's also rebounded very, very quickly. And markets do go up over time. So we had a really, quick pullback. Volatility spiked all the way to 65, which was very unusual. And we've had a nice recovery since then. And this happens all the time. So let's take a look at, Matthew, why do these things happen? Why do we have such a big pullback?
Why do we have such a big pullback? Well, you know what? How many times this year have we said we're waiting for this catalyst?
Yeah.
And finally we got the catalyst, and also, which should be no surprise, the risk that had the greatest impact was the one that we typically didn't identify, right?
It's
And
always
that
the case.
and that's always the case, right? So is that a good thing for risk management folks or a bad thing for risk management folks? I don't know, but like
It's
maybe we
what
can
you
have that.
can't see.
We can have that philosophical discussion another day.
Right.
But that did cause that kind of tech rotation. Now that being said, a lot of the technology companies that are heavily invested in AI, like the semiconductors primarily, they have been running up and up and up and up, and people are literally chasing after them, right? And this gave a nice breather to the market. And this was due to a number of things. One was earnings that were they're okay, not the greatest. We followed some kind of like weak manufacturing data, which is like, yeah, okay, fair enough. But then the big one was this unwinding of the yen carry trade, which we'll talk a little bit about that. And really wasn't, and that had to do with like interest rate movements combined with currency movements, combined with what certain bankers, like government bankers in Japan, had to say. And like unfortunately, they all collided at the wrong time, and it caused literally about 24 to 48 hours of real panic. That's what happened with that one fine day when VIX spiked to about 65. Omar was fine because he was in the Mediterranean sailing the seas, but us over here, we had to endure that, but only for it to be kind of reversed out a little bit while after that, right?
Now, I was going to say one thing you want to take note of: if you believe in your positions long term, if you believe in the companies you're investing in long term, when you have these sort of pullbacks, they have to be viewed as buying opportunities. That's the main way to look at things. If you don't look at them that way, then why are you investing in the company? For example, Microsoft pulled back substantially, Apple pulled back substantially, Tesla pulled back substantially. Now, I'm probably the biggest Tesla bull out there. If you believe Tesla long term is a great value and where you think it's going to be going, can it go lower? Of course it can go lower. Who knows what's going to happen in the short term? But you have to start looking at these things as buying opportunities, and that's what we did. We looked at them as buying opportunities, and we did buy as much as we could on the downside. And hopefully there's another pullback in September and October where we get an additional pullback and we get to buy again. But this is a normal course of business when it comes to the markets. Let's keep going.
Yeah, and so let's just to round out the chronology. Like Omar is absolutely right. Like it's kind of counterintuitive. Like, don't you want the fund to be up? It's like, yes, but the way the fund goes up is sometimes more easily performed by having an opportunity when the market goes down to get back into better positions, and then the fund goes up even more because you got in at better prices, right? So it is a little counterintuitive. So that's really important. That's why it's really important that we believe in the themes of the fund and what they're investing in, right? If you don't believe that, hey, AI is going to be a big thing, or EV is going to be a big thing, or cloud is going to be a big thing, then this fund may not be for you, right? Like, you have to believe in the theme, because then when there's a buying opportunity and the markets turn around, and we do know that markets oftentimes are overzealous when they turn down, right? And they turn down potentially far too much than they really should, right? But that gives more opportunity on the upside afterwards, right? So rounding this out, then we had a couple of interesting pieces of data in terms of uh, retail sales and CPI, and we're going to talk about that just this a little bit. But let's move on here, and that's kind of what's happened over the last, I'd say, like 4 to 6 weeks, right? So, Nasdaq's fall started on July 17th, and part of it was like, the investing community basically said, listen, like, these semiconductor companies, they've had enough of a run up, right? And people started taking money off the table, right? And then there's a little bit more when there's an inflation report out, right? And then, of course, Mr. Trump, or President Trump, said, well, accused Taiwan of stealing U.S. semiconductor business, which hurt the chip stocks. Like,
and this goes back to what we talked about.
This is something that just happens sometimes, right?
Right. Yeah, we've talked about this multiple times. In the short term, the stock market is a popularity contest. Things like this will affect the market short term. Long term, it's a weighing machine based upon earnings. So every so often, you'll have something like, let's say, for example, an assassination attempt, geopolitical.
No, you don't get every so often an assassination attempt. Like, when's the last time there was an assassination attempt?
Right. Yeah, just things will happen, right? But what it does not do is it does not affect the profitability of the company you're investing in, more than likely. And that's what really what you want to, like, that's what you really want to focus on. You don't want to focus so much on, okay, on July 11th, we had an inflation report, which was not seen as favorable to the market. President Trump, or former President Trump, accused Taiwan of stealing USA's semiconductor business. Now, just saying that alone will be a problem for the markets. So whether it's true or not, it's not the point. The point is, just saying it alone creates a problem. But does that affect necessarily TSMC's corporate earnings? No, not really. But just saying it affects it short term. And we want to use these pullbacks as buying opportunities, and that's what we're going to keep doing on a go-forward basis. Let's keep going.
Yeah. So, we had, I would say, in a nutshell, like, this second bullet point is actually pretty accurate. Like, I think earnings were okay, but I think people are more concerned about guidance, right? Now, guidance is generally optional, guys, right? It's not required that they produce guidance, right? But some people do. Some companies, a lot of companies, say, do issue guidance, right? And the guidance was, this last earnings season was a little lackluster, and that also caused a little bit of saying, oh, okay, well, maybe this tech sector, maybe this AI industry has had its kind of run for now. Let's take some money off the table, right? And then I think there was some discussion about, okay, well, you know what, like, AI like 1.0 is going to be, the winner is kind of like Nvidia and AMD, et cetera, et cetera. There's a little bit of talk of, what is going to happen with AI version 2.0, who's going to be the winner there when it gets more advanced. It's like, okay, well, now perhaps we're jumping ahead of ourselves, but a little bit of that discussion happened as well. Last week of July, or second last week of July, right? You did see some lower figures come through, right? Manufacturing came down a little bit more. VIX jumped a little bit. Well, actually, a lot. And
Also,
we did see signs of, we did see some rumblings.
Talking about PMI, producer, manufacturing index. Any number below 50 is considered a sign of a recession. So when the market showed this, what the stock market is thinking, okay, well, maybe we're headed into a recession here, and we have to pull back the values on positions. Why? Because we may be headed into a recession, or we may be already into a recession. What does that actually mean for corporate earnings? Well, that means is, so if manufacturing PMI is below 50, that means you're in a recession. What does that mean? That means people have less money to spend on stuff.
Mm.
So not only are you not manufacturing as much stuff, people have less money to spend on things. And that signals lower corporate profits, and that becomes problematic. And that's what kind of spooked the market out. But it's also had a huge run up in the first part of the year, so it's not something that's not expected. And we've known VIX has been so low for so long. We were at 12, 13, 14 for about 7-8 months. And that's, generally speaking, not a position you're going to be into for a sustained period of time. So eventually, volatility spiked. And we were in a position where we had a decent pullback. But because we are long-term believers of the market and of this technology, or of technology in general, it presented a pretty good buying opportunity.
Yeah, absolutely. So this is kind of rumblings before the storm, guys. And this rate cut kind of issue, it kind of exacerbated. I don't know if anyone monitors FedWatch. It's a tool on the CME website. It shows like what the likelihood of a no rate cut, 25 basis point rate cut or 50 basis point rate cut is. For a time being, there was rumblings of a 50 basis point rate cut come September 18th, which is actually I think that would be rather terribly received by the investing public, in my opinion, right? I think the investing public might be so used to seeing rate cuts in the 25 basis point denomination that to see something at 50, that might be interpreted as something going horribly wrong, right?
Right. So when you're increasing interest rates, what you're trying to do is trying to slow down the economy. So what the fear is that you have increased interest rates too much, slowed the economy down too much, and therefore a higher interest rate cut is needed than initially anticipated. So instead of having 25 basis points, maybe 50 basis points is required to actually get the economy back on track. And what the market gets spooked out about it is the market thinks, well, did you guys go too far? Did you increase rates too much? And if that's the case, you're going to have to cut quickly. And also that would affect corporate profitability. So a 50 basis point cut may be in store, but Matthew, I'm in the same
Yeah,
boat as you.
that's quickly got evened out. Like you
Yeah,
can see day over day, it got evened out, and now it's like right back to like it seems that according to that FedWatch, like the 25 basis point cut is like almost baked in right now.
correct.
Right. So the only ambiguity there is like, hey, what's going to happen about what words they choose to include in the event they cut rates by 25 basis points, right? Because the Fed can impact markets by the number by which the rate goes up or down, or nothing at all, or by not or but and by the words they choose before, during, and after, right? And some words are coming out this week. There's, I think, Jackson Hole this week, right? So yes.
Wyoming.
Yeah, Wyoming. Never heard of the place except outside of this context, but I'm sure
Right.
it's a lovely place. So, anyways, what ended up being the actual catalyst was this yen trade, and like, well, who in the heck has heard of this yen trade, right?
And this has
And
been
yeah,
going
it's
on
been
for
out there for a
years.
while. It's been going on for years, just not publicized for years, right? And Japan's an interesting place, and it's an export society. They want to keep their rates nice and low, and they had -1%, -0.1% rates for the longest time. And earlier this year, they jacked them up to a whopping 0.1%, and that people taking notice, and then they jacked it up again to 0.25%. These aren't crazy moves, but then they started to say, well, yeah, we don't mind, moving rates up and up and up. And what happened was with these currency traders said, oh, really? And they started buying yen and appreciating the currency.
Right.
So what's happened in this trade in the past is that people have borrowed yen at a super low rate, converted it to US dollars, and sometimes I even hear pesos, and then invested it in as anything as boring as like treasuries or even equity assets, right?
So it's kind of like getting free money. If you're borrowing money from Japan at 0.1% and you're investing in the US at 5% or higher, let's say in a different country, all that gap is yours. But what happens is if Japan all of a sudden starts increasing interest rates, the value of the currency, the yen itself, starts going up, which obviously massively impacts your profitability because you have borrowed in yen.
You got to pay
Secondly,
back the yen.
you got to pay back the yen. And secondly, you're borrowing not no longer at 0.1%, it might be 0.4, 0.75%, and that gap reduces, plus the value of the yen has gone up. So what does that do? That causes people to stop doing that. And that creates a problem in the market as well.
Yeah, so the lion's share of the loss there is actually the currency change. It wasn't the interest rate change. And
It
this
was the
spooked out
currency.
the market because then some Japanese bankers decided to say, well, yeah, we're okay increasing rates, and that quickly got reversed when when North American markets tumbled so much. And that was the day that Omar referenced, when the VIX went up to like 65. I think intraday it actually went up to even higher than that. Um, and very quickly thereafter, another Japanese banker said that no, we're not going to do anything like that until international markets kind of settle. And that kind of put rest to it. And that also, in my opinion, acted as a catalyst as well to say, oh, okay, we don't need to worry about this risk, which was largely unrevealed to ourselves. And I think that acted as a catalyst to now have the market carry on a little bit of a mini rally we've been seeing as of the last week or two. Definitely since the end of July, beginning of August, right? And that kind of takes us up to date here, right? And this summarizes exactly what we just said. But yeah, that is what's been happening now. Now that makes for actually a pretty interesting summer, right? Middle of July or early July into August, like typical summer months, makes for a pretty interesting summer. Now, on top of that, right after that, we had a little bit of slowing the labor market. And that was deemed as a good thing because, hey, that means it's more of a sign that rates will be decreased in the United States, and that soft landing and the avoidance of the recession, of a
But
recession, becomes
Matt,
less of a probability.
that's the question, right? The question arises when you have a slowing labor market. The question arises: did the Federal Reserve increase interest rates too much and for too long? Because if they did, they caused too much damage to the economy. So what you're doing, what you're trying to do when you're raising rates is slow the economy down without killing it. Okay, that's what you're trying to do. So in hindsight, when you look back at it, the question you have to ask yourself is: were interest rates too long and too high? And if that's the case, then you've caused more damage than you needed to cause. And that, again, spooked the market out. And what does that hit the most? Well, that hits technology stocks the most. And that's exactly what happened. We had a nice little pullback here, 13% pullback. That's substantial.
Absolutely. So it was interesting. Actually, day over day, we had, even after this, we had a CPI number that came in, more on target. Like we're seeing like definitely a two-handle kind of CPI number for the year. And then the next day we saw, oh wow, still strong retail sales, and that was literally last week. That's what happened last week, right? So it's like kind of a tale of two cities. Like how is inflation going down, but retail sales still progressing? It's like, how's that happening, right? And that's what we saw last week, and that literally brings us up to like right now, right? And now we are patiently waiting. There's Jackson Hole conference this week. We'll see how the markets play out. And I would say the next very, very large kind of meeting is going to be that September 18th meeting, right? So what does this have to do with the fund? Well, we need to kind of manage this in terms of how these different macroeconomic events and international events, what is the impact on volatility, and how can we sell volatility effectively, to produce overall good results in the fund. That's what we've been focusing on. There have been opportunities, of course, and we've gone into them. I think pretty efficiently. And we are constantly monitoring the portfolio and volatility to see what's going on there, to see where we can capture some more gains there, right? we'll talk about a little bit about seasonality and whatnot towards the end. But again, obviously, we are headed into like this is like next week is going to be August the 30th, right? So this summer is like literally flown by. And you know, a lot of the options we're writing actually in the portfolio, they're expiring now, you know, maybe next week, but September 6th, right? And very specifically September 6th, because we want to see, you know, what is that vibe in September going to look like, right? Is it going to be, you know, come back from summer vacation and sell everything, or is it going to be, you know, a more rejuvenated kind of look and say, okay, well, let's realign. Maybe there's a flat market, maybe it goes up a little bit. But you know, history will tell us from a seasonality perspective, you know, September and October, they're months to be cautioned by. And that's
Exactly.
exactly what we're trying to that's what we're trying to achieve. Have some dry powder so that if the opportunity rises, we will be able to execute at better prices.
Right. So September and October are traditionally the two worst months of the year for the stock market. So if you know that's the case statistically, historically, what you want to do and what we are doing is we're going to leave as much money as we can in anticipation of that happening. If it doesn't happen, fine. We're mostly long because we ultimately believe in a lot of these positions. However, if it does happen, it'll give us a tremendous opportunity to be able to buy some stock on the low. And that's what we're looking to do into September and October. Um, you know, being an election year, you don't know how it's going to actually, play out. But September and October generally not great months. September being the worst month of the year, October being the second month of the worst month of the year. But that's not necessarily the case in election years. So we know all that. But ultimately, what we do is we believe in these companies. So when you have a pullback like we had just recently, what our job to do is to be able to buy stock on the low and buy as much as we can in anticipation because we believe that they're ultimately going to be higher. So let's see what happens in September and October. If there is a pullback, more than likely we will be buying.
So yeah, so you can see this is the fund as of last week, the 16th. You know, a lot of these positions are nearing their desired exposure. Some have certainly some room to get there. Some are slightly a smidgen over by, you know, a very fractional amount. But we're by and large we're pretty happy with this exposure right now. I think, you know, within a alpha type of fund that is seeking outsized returns, that these are kind of these are the industries that we want to be in. We don't see any of these industries as potentially laggards. So yeah, we're quite happy with this mix, and we're actually on a daily basis kind of monitoring the mix to see, you know, what can be tweaked, what specific stocks are under or overperforming. Like we are doing that analysis on a literally a daily basis, right? So yeah, anything David or Oma, anything you wanted to add about, you know, our current exposure versus desired exposure, and also the stocks which we're exposed to?
No, I would just say that going into September and October, if we do get a pullback, it may look ugly temporarily, but it would be something that we would welcome because we would want to get into long positions. We would want to deploy capital. And the good thing with us is because we constantly have new money coming in, it allows us that opportunity to be able to invest if the markets pull back. So ideally, we'd want it to be what it has been historically, which is a pullback in September and October. David, anything for you?
Yeah, just going to pick up on a couple of themes that everyone has been talking about. Um, just stepping back from 30,000 feet, what precipitated the increase in interest rates was because we had inflation. And the central banks are committed to having a manageable rate of inflation. Academically, it seems to be you want slightly positive inflation. That's why the central bank targets are typically, up to 2%. Obviously, coming off the COVID pandemic and all the other stuff, we had pent-up demand, supply chain issues, and inflation went up. So the central banks did what they usually do, which is to raise interest rates. And they also did another thing in the background, which was to reverse a practice known as quantitative easing, which was in practice for a number of years. That also had the impact of raising interest rates. The whole point from the central bank's perspective of raising interest rates is to reduce aggregate demand by and Part of that is simply because people's discretionary income is lowered by the fact that they're spending more on they're paying more in interest, which means that they have less money available to make purchases. And I think the central banks who are data driven have deliberately, especially the Fed, US Fed, kept interest rates high, and they have achieved what they set out to do, which was to lower aggregate demand, which reduces pressure on prices, etc. Supply chain issues have also been reduced. And, to pick up on what Omar and Matthew were saying, the issue is how good are they at that? And so the big issue right now is, okay, interest rates have reduced aggregate demand. We're seeing weakness in the economy, and there's increased concern that the U.S. Job growth last year was overstated by about 822,000, where they were expecting a million overstatement. It came in at around 822 on a preliminary basis. All that means is that there is a softening. The economy is still growing. It's actually doing quite well, and quite happily for the central banks. They are seeing genuine weakness in aggregate demand. It's there in terms of spending. It's there in terms of a slight increase in defaults on credit cards, etc. at the margin. And they're also seeing that the employment was less robust than they thought. Now, that means that since the central bank is data driven, they have way more reasons to sit there and say, and this is what's really, really, really interesting. And one of the reasons why central banks were so aggressive when they raised interest rates is right now, with interest rates at 5% in the US, approximately, for the risk-free rate, they actually have powder to make significant monetary changes to allow that if aggregate demand really falls too fast or begins to accelerate way faster than they expect, they have a lot of interest rate cuts available to them. So imagine when your overall interest rate is 1%, half a point to 1%, and the economy is struggling, you have very little flexibility. But now we have, or the central banks have, extraordinary amounts of flexibility. And so that is why you're seeing so many people, especially in the States, make bets on significant interest rate decreases. And right now, depending on what database you're looking at and how it's calculated, they're expecting approximately 4 interest rate cuts, totaling at least 1% over the next 12 months. Which is good because the economy is growing and we're going to get relief from the central banks. But the problem, again, is for stocks that the Theta Alpha is focused on. Their pot of gold is way out. These are what are called long duration stocks. And so as interest rates go up, the discount factor is higher. Therefore, the value of the pot of gold today is less. So everything being equal, the fund should benefit from these interest rate decreases that will be coming in. That's a positive. That is a good thing for the fund. The bad thing that the fund is experiencing is whether or not the growth in earnings can be maintained. And what we're seeing is some pressure and guidance from some of the companies saying, well, maybe we're not going to be growing as fast. That's okay. These stocks are still growth stocks. And it's not clear how growth is going to play out in response to A, the lowering of interest rates, and B, the general slowdown, which has been encouraged. But again, the good news is that the central bank has the ability to lower interest rates materially, not just 1%, but they could easily lower interest rates 2.5%, because relatively speaking, interest rates are very, very high. If the normal risk premium is 2% and inflation is 2%, or you can expect interest rates to go from 5% to 4%. And so this is good. Now, what we have a challenge to do is to maintain the discipline and confidence in our research that our analysis is correct, that the companies that are in the portfolio will still continue to generate and experience significant growth in the future. It's just that in the short run, the path is going to be volatile. And that is perfectly normal. Anyone who's ever been in the markets for any length of time knows that that path is never straight. It is always up and down. But again, the most important thing is not where it is from one day to the next or 1 month to the next, but is it trending upwards over time? And that's why, again, we keep explaining to everyone that the investment horizon has to be long term. And the best metaphor I can use, and I've mentioned this before in the past, is if I put an X on the wheel of a tire, as the tire rotates, that X is going up and down as the tire goes around in circles. But if I put an X on the axis, I'm not going to see the volatility. But what I should hopefully see is a trend. Is the trend up, flat, or down? Well, right now, if you measure the trend over a month, 6 weeks, it's a bit down. But that's too short a time frame to measure it, because then what you'll end up doing is converting an investment strategy to a trading strategy where you try to time the market. Well, there are very, very, very few people who can time the market well, and there are certainly even less who can time the market well over time. And that's why investing is preferred over the long run to people who try to trade the market. So we're sticking to our guns here. We're focusing on the investment, our investment research, and accepting the fact that we're now in a period of volatility. And as Omar and Matthew pointed out, the next few months are going to be quite interesting. It's a bad time of the year, so there's some seasonality. But we do have 2-3 significant events going on. We have a US election that has now been converted from a walk-in for Trump to, hey, depending on who you are following, Kamala Harris has a clear path to winning the White House that did not exist for the Democrats literally 6 weeks ago. That's not to say that she will win, but it is abundantly clear that the only score that will matter is what happens on election day. That being said, we know that the feds are going to respond to the data that they've been receiving, so it's not clear exactly what they're going to do. And thirdly, we know that AI and the investment in AI is continuing to play out, but what is also clear is how it's going to play out. It's too soon to see all the benefits. So yes, it's going to be, it's just going to be a little bit volatile. And that is consistent with what we would expect with the construction of this portfolio. Hopefully that's a different way of putting things into perspective.
And we can use that volatility to our advantage in terms of buying when things go a little bit lower. There's a question here from Lorian. I heard that AI is replacing some companies' workers in order to increase their earnings reports. Thoughts? Yeah, very much so, Lorian. As AI becomes more and more prominent, you're going to find this going to be a bigger and bigger issue where workers are going to be replaced because they can be replaced through AI. And this will increase corporate profits, because if you no longer have to pay someone to do a job that's let's say a software can do for you, yeah, it becomes more and more accretive to earnings. So as AI becomes more advanced, I would expect this to happen more and more. But what this will mean is human beings will move up the food chain. So overall, it's beneficial to corporate earnings, to the economy. but in the short run, it could be problematic. But yes, this
Let
is
me, let me
already happening, and we expect it to happen even more on a go-forward basis.
let me just put something into perspective related to what Omar said, and that's the short-term dislocation.
Yeah.
Literally 100 and in 1880, I guess that's now 160 years ago. Oh my goodness, I'm getting old. Um, there were no such thing as cars. You cannot imagine the number of people who are involved with horses, running barns, cleaning streets, maintaining um, um, your
Blacksmith.
blacksmiths, all of those people. I mean, there was an extraordinary number of people who were involved with the associated with the industry of having horses as your primary mode of transportation. Yeah, obviously you had railroads as well. Eventually, the car came in and displaced the horse. All the people who were involved in and working with um, the horse industry or associated with it, a lot of people obviously clearly lost their jobs. And so they were then forced to find alternative forms of employment, and they would have gravitated to the industries and the areas that were offering them the ability to increase, to do better things with themselves. Unfortunately, with capitalism and with growth, displacement is a continuous fact of life. This is where Schumpeter made his famous comment that the very success of any company or industry often creates its own seeds of destruction. And that's perfectly normal. Um, we are going to experience perhaps some increase in temporary unemployment. But then that also means that those people are going to go find something, invest in themselves, and find something that's a more productive use of their time and skill set. And let's face it, there is a shortage of labor in the States. There's unemployment rates are pretty low. And that's even after the influx of an extraordinary number of legal and illegal aliens in the United States and Canada, for that matter. Um, Emotionally, it's devastating to find yourself redundant, but it's a fact of life that is going to affect all of us. I've worked in the financial services industry for nearly 40 years, and every single firm I've ever worked at, other than a bank-owned dealer or a large international transplant, every single firm that I've ever known has disappeared. And, you know, a lot of times they get purchased by other companies, and that purchase results in a series of redundancies, and those people have to find new employment. That is just what is going to happen. It's noisy and it's hard and it's emotionally draining. But at the same time, allocating resources to more productive sources in the society makes society better off. And these companies are large enough and significant enough and are leaders in their category that they will benefit ultimately, I think, from the changes associated with the disruption and implementation of AI. There you go.
Thank you, David.
Agreed. Thank you, David. All right. So let's move on to what's the summary fund positions. So we see, generally speaking, that there's about 95% allocated, guys. So, you know, we're quite comfortable with that right now, for sure. There's new money coming in every day as well. So like we're constantly trying to allocate that money as it comes in. So that's
Yeah.
really important for us as well. And that allows us a lot of like that. I don't know how much money is in the pipeline, but literally every couple of days there's money coming in. So that's really good for us. You guys, thank you so much to all you guys keeping Omar and David and his team very, very busy. That's awesome. We see here average days to expiration about 28 days. So again, just under the month. So if you look at you know, it's August August 21st, so at about, you know, we're about August September the 19th. That's for covered calls, right? So again, this is as of last week, right? And as of last week, there were no puts written. We have put some on the portfolio between the 16th and now, absolutely. but as of last week, we were kind of fully deployed there. We do want to keep a buffer of cash of about 5-6% regardless, and that is simply to capitalize on a rainy day, and that's what it's there for. Okay.
Yeah, we want to reiterate here, if we get a pullback into September and October, which we think we will get, as new money comes in, we will deploy that capital because we believe that the markets will be higher by the end of the year and into 2025 and on a go-forward basis. So that's our job. We're mostly invested right now at 94.9%, so substantially invested, but we are anticipating a pullback and looking to deploy capital as that pullback occurs.
Okay, here are the fund details, guys. It is registered accounts are allowed. Obviously, from day one they were allowed. So like RSPs, LIRAs, TFSAs, RESPs, etc., etc. The fund code, we are on Royal Bank Dominion Securities shelf now, so you can buy that through your fund advisor at Royal Bank Dominion Securities, CCI 705. And yeah, contact Omar or myself or David and his team if you want further information there. Let's continue on here. What to look out for, Omar? August and September.
Yeah.
Thumbs up or thumbs down? Well, let's be cautious.
Well, thumbs down, obviously, but thumbs up if you're a long-term investor, right?
Absolutely. It's so historically speaking, like seasonality is a real thing. I grant you that it's a real thing, but don't forget, every month is just really a data point, right? So who's to say that, hey, September's downturn that we are expecting might turn to October's downturn? We don't know, right? But we do know, hey, when you look at the past years, September is pretty ugly. Okay, are things sizing up for that? Are there economic events on the horizon that could cause that to be the case? Yeah, absolutely, right? And maybe just maybe there's a run up until September 18th when the Fed meeting is announced, comes to fruition. And if something is a little negative there, that could cause markets to erode into the latter part of September. I don't know. Nobody really knows, right? But what we can do is that we do know our investment thesis. We do know what tools we have at our disposal, and that's our job to kind of navigate these waters as best we can and to capitalize as best we can. All right.
Just a question here or a comment here from Harminder. Says, hi, gents. It would be good to show month-over-month returns on this slide once the fund stabilizes, just to allow us to track performance, etc. Yes, we do planning on doing that, Harminder, in the very near future. Now that the fund is growing in assets and it's becoming of a substantial size, we can compare it month over month to see how we're doing against the S&P 500 and the Nasdaq. So that will be forthcoming.
Yeah, absolutely. As now, guys, compliance departments do look over this deck on a weekly basis, or however often we are preparing them.